First of all, I really appreciate everyone finding time on their busy schedules to join this Friday evening for this webinar. And I just want to set up some initial framework for the webinar. As I mentioned, I plan to do this webinar in a way that I'll talk for 45-50 minutes as I have a lot of information, as I have a number of slides to go through. Then I'll open it up for any questions for 10 to 15 minutes. Cookie, who is with me over here as my assistant, she will be able to take any questions. You have my contact information, and you could be in touch with me regarding any pending answers or any concerns that you have. Before I get into the slides and I go about the main items that are on this webinar, I just want to read this education only disclaimer, and I need to read it word by word because I will be imparting some knowledge in terms of having it just claiming that this is an educational purposes webinar only. So I'll just read it word by word. This information is for educational purposes only. The provider advises the information/content are for educational and/or illustration purposes only, and are only provided with the understanding that the provider is not engaged in rendering legal, accounting, financial planning, or other professional opinions. The following content has been researched and published in good faith, without warranty or liability for any erroneous, incomplete, or misleading information. Please note that investing involves risks. Any decision to invest is a personal decision that should be made after thorough research, including a personal risk and financial assessment and review with your legal and financial experts. Results are based on each individual, the action they take, and the time and effort they put in. So I had to read this, guys, because of the nature of information. I will get going. Before I start this webinar, I just want to thank few individuals who have been very helpful in terms of gathering this knowledge and inspiring me to do this webinar. So the first name I want to take is of Dion Baig. Dion Baig is with Butler Mortgages, and he is more than a mortgage broker. He is a coach in terms of investing. So some of these slides, some of the content has been inspired by attending his seminars. He's a speaker at Toronto Real Estate Board. I also want to like to thank Zan Hassan. Zan is also a mortgage broker, and I have had discussions with him regarding some of the topics in this webinar. The third one is Khurshid Umar. Khurshid is a close friend. He is in corporate taxation. He has been a great help in terms of providing insight regarding all the aspects related to properties, taxation, and things like that. So he's well versed in real estate properties related issues, taxation issues. The last one is a person that I have never seen or met, but I'm just gonna show that on the screen. His name is Callum Ross. I hope I'm holding it straight. So he is the author of this book, Real Estate Retirement Plan. And this is a great book, and you could write down the name and you could maybe refer it later on. Again, the Real Estate Retirement Plan. There are lots of books out there on real estate investments. The unique thing about this book is that the content is mostly Canadian. So it's very much oriented to Canadian market, and you will find a ton of books on US markets, and because of different market, different factors over there, you cannot easily translate some of those things into Canadian market. So with that, I will get going, and I will start with my first slide. So the power of real estate investment. I have the framework for this webinar is such that I have set it up in a way that I answer a few questions. I will go into what, why, how, where of real estate investing. Before I go ahead, I want to let you know that the audience is not just seasoned investors or people buying their investment properties. If you are renting, if you are a first-time home buyer, if you are buying a principal residence or buying your first investment properties, all of this information that will be presented can be used and applied in those situations. So it's a very broad audience as such. Once somebody gets in contact with me and I understand their specific situation, there is more to let them know and guide them in the process. But that's how this seminar is. Okay, a little bit of my introduction. Some of those who know me, I have a master's in business and administration. I'm a project management professional. I've been very lucky in terms of having experience of working in world-class organizations. I have been in a number of industries, and being in the project management, program management field, it was a big advantage for me to be able to work in the aviation sector, in the health sector, in the telecommunications sector, in the financial industry, and now in the real estate industry. So I have tasted waters of different oceans, and that has an impact on my personality and my approach also. Uh, as stated in the third bullet, I have a project program management background, and the way I operate has the project management has it influenced me in that sense. And the biggest thing that's about me is that I'm an investor myself. So I am practicing what I am preaching. So I own a number of properties, and I have gone through all the pains of being a new investor, learning the ropes and getting from there. So that's a bit of a small introduction as far as I am concerned. Guys, I had to do this webinars for some of my friends, some of the investors overseas. So I tend to kind of go beyond the time. So I'm gonna try to keep it within the 45-50 minutes. So just bear with me, have patience with me. So what is in it for you? I told you about myself, but what is it that the audience may be looking for? And some of the highest concerns that I have gathered from my clients, from general feedback, is people want to become mortgage free. They want to pay for their kids' education. They want to have a comfortable retirement. And that could be done by investment, but the focus here is how they could utilize real estate investments to achieve those goals. There are a number of other big considerations, especially in today's market, being helping your kids to be able to get a foothold in the property market, and that's a major consideration here. Sorry, I think you lost my picture. That's a major consideration here. Considering the price of the properties, considering the stress test, it has become extremely difficult for the younger generation to be able to afford housing. So you could play an important role in that aspect. Okay, so let's just talk about current market outlook and change in consumer behavior. So I've been getting this question a lot from a number of people. I have had in the previous 2 to 3 months, the first question anybody who calls me is asked, what's going to happen, what's happening. Especially this COVID situation has the world economy has come to a halt over here, and there is a lot of uncertainty, and one cannot undermine the gravity of this situation. However, I just want to talk about the short-term or the long-term aspect of this. One thing which keeps us hopeful is that I see that everything is falling down and things are really stalling here. However, there is an end game here, and the end game will be initiated with the vaccinations once they become available. Now that is I'll leave the vaccination aspect to the experts, the medical experts. I will just talk generally about there are two parts of this spectrum. One end of this spectrum is that you're really pessimistic about this situation, and you think that we will have to live with this and it'll be a lifestyle change. The other is overly optimistic, or you're a Pollyanna and you think that in the next 3 to 6 months, some major intervention is going to change the situation. In my opinion, and what I have heard and listened to the experts over here, and if we take a middle ground here, it's the beginning of the year 2022. That's the first quarter of 2022 when things start getting back to normal. So if you take that time span into consideration, in between that period or up to that period, there would be a lot of short-term trends. So and there would be a lot of roller coaster type of a real estate changes that would take place. We are already seeing that. Initially, when this situation started, people were of the opinion that this is an opportunity and the prices are going to go down. However, due to the shortage of listings out there, prices have actually shot up. So that's quite that's quite a twist. And now, right now, it's a seller's market, and buyers are really competing, and the multiple offers are become norm in a number of locations. So that's a short-term trend. I'll leave it aside, and I'll try to kind of discipline myself not to say too much on each slide. But there are a couple of trends that are important, and those trends are not new, but those trends have been intensified by the current situation. And that is, number one, the proximity to work, or the fact that you need to be close to your workplace has become less important. Now, with 3-4 months down the road, employers have data proving that people who are operating remotely, their productivity levels are fine. And what that has turned into is people getting the focus is shifting towards suburbs. People are moving farther. But as I said, this is not a new trend. This trend has been there since 2011. Pricing in the central core of the city has been so high that if you go to the east, to Oshawa, if you go to the west, Hamilton, if you go north to the Barrie, in all directions, you see that there is a situation of almost markets are becoming saturated. But this COVID-19 situation has really intensified that. And in my next slide, you will see what that has done is that couple of major things that, and as I said when I was promoting this webinar, is an opportunity, is people have an opportunity to buy a bigger place at almost half the price of a central core of the city. So people are availing this, and they had been availing this opportunity. So while I was preparing for this webinar, I came across, and I was reading articles on this, and these are some recent articles. Torontonians are fleeing the city for cheaper homes, more green space, and a balanced life. Suburbs boom, Toronto fizzles as world's major cities witness a pandemic exodus. And there is another one over here. Cottage country real estate is booming as Toronto residents looking to leave the city in droves. So there is a bit of a dramatic tune to these headlines. However, it has been happening, and it's just intensified because of the current situation. Okay, now this slide is the I would say I'll build it up from here. This is the core of my presentation over here. I want to take three investment classes, the three investment classes that most of the people are familiar with and they focus on. And I want to talk about how banks make lending decisions. So I'm going to compare here in these three columns: business, shares, or mutual funds with property. So let's just start with business. Let's say if you have $100,000 and you go to a bank asking for a loan for business. First of all, bank is not going to be happy because 80% of new businesses fail. So they would have stringent guidelines to go through. However, let's say your feasibility studies is you have done your homework and things look good, so they agree to loan you that 100,000. What the bank would do is match what you have and give you another $100,000. Same is the situation with shares. There is something called a margin loan. And if you want to invest in mutual fund, you could go to a bank, and if you have $100,000, they would match it with another $100,000, and you would have $200,000 to spend. Keep in mind, in case the price of the stocks go down or they're having losses, they could recoup from you anytime. Plus, the loan that will be given to you would be also on the higher interest rate. Now I'm gonna compare that with investing in real estate. Let's say if you have $100,000 and you go to a bank asking for a loan and you have the down payment of 20%, bank would be able to give you $400,000. That would make the total investment as $500,000. Now, it looks pretty simple, but we need to clarify this a little bit more. We need to analyze how banks are making these lending decisions, or how could you translate that decision of a bank to loan you 4 times the amount that you have. In simple words, bank considers investing in property 400% safer as compared to investing in shares or business. And that's how it translates. Or it is 400% more riskier to invest in shares and business as compared to investing in property. And there is a solid reason for that. Let's say if you get a down payment, you have a down payment, you buy a property for $500,000, and the next day you go bankrupt. Bank, in a matter of days, if not weeks, can put that property on market, have it sold, and they can recover their losses very easily. Whereas that's not the case when you go look into business or shares. Let's take this analysis further. Your goal is to make $100,000 in the next 5 years. And these are the 3 investment vehicles that you are using. In case of a business, if you have $200,000, you would need a 50% return on that to get to that goal of $100,000 additional, which means you would need to have 10% growth on a yearly basis to reach that goal. Also, the same scenario with shares. And I have, it's very hard to come across somebody earning double digits in mutual funds. I'm not denying the fact that there may be some people, but the fact that in current markets, if somebody is getting 4, 5, 6, 7%, they are quite satisfied with the scenario over here. On the other hand, if the goal is to make $100,000 and you invest in a property, you need a return of 20%. And you just need a return of 4% on yearly basis to reach that goal. The whole point of this slide is to show the power of leverage. It's instead of $200,000, $500,000 are working for you in this scenario. So I'm going to build it up from this slide to the next slide. And this slide is showing the compounding effect over here. Let's say that at year 1, start of year 1, the value of your property is $500,000. And we are assuming here that the property will appreciate by 5% on annual basis. And I know that's a big question. If everybody was unmute, everybody would have started yelling at me right now. But I have done my homework in terms of why I put 5% here. And I'll go into it in the next slide or in the later portion in this slide. So assuming there is a 5% appreciation, the increase in value is $25,000. At the end of the year 1, your value of the property is $525,000. Second year, the $525,000 become the value at the start of the years, and the same appreciation percentage applies to it. I don't want to go through everything. At the end of year 5, the value of the property, which started at $500,000, is now $638,141. So that is the difference between the purchase price and the new price is $138,000 here. And that's not the only thing that's happening over here. The compounding effect that's happening here. there's at the same time interest pay down based on the interest rate of 3.5%. Now, I have kept it at 3.5% for a reason, because I wanted to stay conservative. I wanted to stay conservative with my analysis on the appreciation percentage as well as the interest rate. Interest rates right now, in some cases, are below 2%. And I don't want to go into more details in terms of that because it varies. However, interest rates have been low for quite some time. So what it ends up happening is that you have almost $52,000 of your equity build up because of the interest pay down, and the difference right now between new value and mortgage pay down is approximately $190,000 more. Now, let's assume that it's a negative cash flow property, which means after rental income and after all the expenses, mortgage and everything, utilities and property tax, you are paying $500 from your own pocket every month. Over 5 years, you would pay $30,000 on this property from your pocket. Still, your return on investment is $159,000 over here. Okay, so I mentioned this number of 5% before I go into my next slide. When I was preparing for this seminar, I read this number somewhere, but I was not satisfied. I myself went into the MLS database, took all the historical prices from the last 4 decades and plotted those on a chart. And I will show it to you in the next slide. When I plotted those values on the chart, the last 2 decades, the average annual appreciation was 6%. And the average annual appreciation in the last 4 decades is 5%, more than 5%. So, and that's just an average number. We're not assuming that all the due diligence and looking at how do you select an investment property and all that thing has been done here. So I consider a 5% appreciation on annual basis as quite realistic. I'll go into that topic later on also because somebody may have concerns. In this slide, I'm just building up on the previous scenario that over a period of 5 years, your potential increase in 5 years is close to $190,000. If you take a look at that $190,000, that is a 189% return and a $38,000 return on annual basis. And I'm just going to go further 10 years, 20 years, and 30 years. And the numbers here are staggering. In 10 years' time, your return is 427%, and you are earning $42,000 annual return. If you go 20 years, your return is $55,000 on annual basis and 1,100% on your original $100,000 of down payment. And 30 years is 2,160%. So I understand, again, as all of you are mute, it is difficult to plan for 20 or 30 years, and in most of the cases, I guess the audience over here, we may be in our 40s, 50s, 60s. I don't know, but one could say that it's kind of far-fetched to think of what's going to happen 20 years from now or 30 years from now. But as an investor, if you're looking at a time span of 10 years, this 427% return or $427,000 is a realistic number to achieve. And that is one investment property. If you want to get into building a portfolio, you could do this 2 or 3 or 4 times, and you could look at the numbers over here. Okay, so this is where I plotted the price appreciation from year 2000 to year 2019. The average price of a property in 2000 was $243,000. It is 4 times now, reaching $819,000. That's 4 times in a period of 2 decades. If I go into the middle, it's doubled from 2000 to 2009. If I go from 2009 to 2019, it's again doubled. So, and that's not something that I think I need to kind of convince too hard people. A lot of us are sitting on investment, real estate investments, which have doubled in the last 5, 6, 7, 8 years. Some of my clients on this call have their properties tripled in a matter of 7 years. And again, I'm not painting any rosy pictures over here. And I'm also not saying that this trend is something that's going to continue and continue. Um, when you invest, you have a long-term horizon. And my recommendation is to at least look for 5 to 10 years of a time frame. Keep in mind, price matters only at 3 points. When you buy, when you refinance, and when you sell. It does not matter what the price is in between. So you need to have a longer time horizon. And I'll go into this in more detail in my other slides. So this slide is also building up on the same thing. If you have a plan to make $2 million in 15 years, at 5% growth, a property doubles every 15 years. If you buy today for $500,000 with $500,000 financed. Now, keep in mind, I have not used that 20% down payment assumption here. And that's the heart of this seminar over here. The fact that you have an ability in some situations, for some individuals to have everything financed is there, and I'll go into that, but I just want to complete the bullet points here. In 15 years, your asset will be worth $1 million with a $300 debt that's their pending mortgage on the property. Your net worth at the end of 15 years for that one particular property is $700,000. You do it 3 times, you get $2.1 million. Now, let's get back to the situation of how to do it. And the reason I have put $500,000 finance for a number of individuals who have their principal residences. You could withdraw that money from your principal residence. And a number of you may hold HELOCs, and you could use HELOCs to get that $100,000 and put it in as a down payment for an investment property. And that's why I say $500,000 financed it. I have a number of my contacts, and I thank Dion Beg and Zan Hassan initially, who can look into the situation. And if you own a principal residence, keep in mind the dormant equity that you have in your home is a big asset, and that can be utilized in a very, very powerful manner. Not just this, the interest rates are rock bottom right now. And I referred to that book, the real estate retirement planning initially. It's too big of a topic for me to say that interest rates will stay low for a number of years, for a long time. As a matter of fact, few days back, Bank of Canada made a formal statement due to current economic situation, they're going to keep the interest rates down for a considerable time. And that is unprecedented. I think never before such a statement was made. And when you read that book and the chapter on why interest rates will stay low, you would be this webinars would be worthwhile just reading that chapter. So let's just go and build from here. Okay, what happens in a real estate investments is there are key profit centers. And not one profit center is at work here. You have multiple things happening. You have price growth factor, you have mortgage pay down happening, you have a cash flow factor, and you have a forced appreciation. And by forced appreciation mean that you have control in case of a real estate investment. You could invest in that property to change its use if allowed, to make it a duplex, for example, maybe increasing your rental income by 30 to 40%, or you could add some value and have it appraised at a higher value. So the reason the investment is so powerful is there are multiple profit centers that are at work here. So this is a spreadsheet that I have taken, and this is an actual scenario. It's not a made up spreadsheet as such. What I want you to look at, there are a lot of numbers over here, is to the purchase price of this property is $300,000. there's a 20% down payment. We assume a $60,000 down payment. We are assuming a 2.99% of interest rate. So I have plugged in actual numbers to keep it as realistic. I have done it for most of my properties, and that's one example. And what I want to show you over here is that if you look at all the expenses over here, taxes, property management, vacancy, that's not a condo, so it's not applicable, the condo fee, insurance, mortgage, maintenance, repairs. This property, if you look at this property on monthly basis, the rent is $1,475 and expenses are $1,527, which means to keep this property, I pay from my own pocket $50 per month, which as a negative cash flow. What I want you to focus over here is this column over here. This column shows the calculations based on a 0% appreciation. On a 0% appreciation, my annual return is 4% and my 5-year return is 21%. And that's 0% appreciation, which is highly unrealistic. If I take it to a 5% appreciation, my average annual return on investment goes to 28%. And my return on 5-year investment goes to 141%. And these are mouth-watering numbers. And if you know the reality, this property in a matter of 4 to 5 years has doubled in its value. So I am giving you a example of a 0 to 5% appreciation. It has appreciated by approximately 20% per year. So I don't even have that charted out over here, the scenario. And that is not to say that every property is like that. It's just an example that I want to give you, that even with very conservative numbers, there is a great return on investment in case of investing in a real estate property. Okay, so when I started this webinar, I say I'll answer 3 key questions. I mentioned that I will give you an example that how could you become mortgage free. So I'll answer a couple of those questions here. So let's assume you invest in an investment property, and over a period of 10 years, the property at a 5% appreciation has increased your net worth by $427,000. In a period of 10 years, if you sell that property and use that amount to pay the remaining mortgage on your principal residence, you could potentially become mortgage free. And why it's important to become mortgage free for too many people is if you take a typical family, 40 to 60% of expenses is what's going on housing in terms of your expenditure. So for some people, it's a goal they work towards. In this slide, I'm going to talk about the second question and provide a solution to a big concern regarding your children's education. I'm going to analyze the RESPs against property investment. So let's take the example of RESPs, which is a registered educational saving plan. A lot of parents, once the day their child is born, go and invest in an RESP. What happens in an RESP is that you can invest $200 per month up to the age of 20 years with a total investment of $48,000, and government would match it up to a max of $7,200. So what the total, your money and government money together, $55,000 is invested. And you can run the numbers with the best RESP plans out there. The best that you could get after those 20 years is $100,000. Now it's a different question, how much of your higher education could be financed with $100,000 after 20 years, but compare that with investing in a property. At 5% growth, your price doubles every 15 years. In a matter of 20 years, instead of giving your child, your daughter or your son $100,000, you could potentially have $1.1 million for them. And that could take care of maybe 2-3 kids' education at that time. There is a difference. It's not as as simple as it seems. The price of entry for an RESP is $200. Price of entry in a property is, in case you don't want to use your dormant equity, is $100,000. So that's the price of entry difference between the two. So now I have answered those two questions, and I'll go to building retirement wealth. As a matter of fact, I can actually address it right now. When I show you the slide, that 15-year $2 million plan with 3 property investments, that's a very realistic number. And for a lot of people who wants to build a portfolio of investment properties, they could reach those numbers, and that could sustain them in their retirement. And don't be fooled by all those pension plans. They are becoming almost non-available these days, and most of the employers are running out of steam as far as any pension benefits are concerned. So that's one great way to kind of think of your retirement and invest. In this slide, I'm going to talk about difference in investing and speculating, and there is a big difference here. When you invest, you have a clear focus and you have multiple exit strategies. Remember, things can go south in any type of investment. So there's a really good quote over here. We often overestimate what we can achieve in 1 year, but underestimate what we can achieve in 5 years. And that's an investment philosophy. You have a 5 to 10 years time horizon. You want to give, you want to water your plants, and you want to wait for the results to happen. What is speculating? That's not having a clear-cut strategy, and you are only relying on the appreciation factor. And by appreciation factor, if that's the only thing that you are looking for and you have not done your due diligence, it's a riskier proposition here. Okay. These 3 bullet points are important. Managing the cost of holding is crucial. The measure of investment is now not how it performs in worst of times. The measure of investment is how it performs in worst of times, not in the best of times. People who lose money in real estate are those who are forced to sell in bad times. So keep these things in mind when you're investing in real estate. Okay, I talked a lot of rosy stuff and the positive side and the benefits, and made you made you like $2.1 million in a span of 15 to 20 years. Let's talk about the risks. Everything has risks associated. But one thing is for sure, and this is where you need to bit of a brainwashing. Risk is not equal to the amount of debt owned. Risk is equal to the amount of bad debt owned. When the debt is for assets that produce return on investment, that produce appreciation, then the risk, it's a good debt. And that's a big change in your thinking that you need if you want to be an investor. Furthermore, risk is a function of 3 main things here. It's a function of demand, it's a function of control, and it's a function of exit strategies. And I want to go into these in a little bit more detail. If you talk about demand, let's just talk about demand. Now I have a question for you, and you can put that in the chat window over here. What do you think is the vacancy rate in Toronto? Okay, I'm not looking at the chat windows here, but let me tell you, the vacancy rate in GTA actually is 1.5%. A balanced market has a vacancy rate of 3%. A vacancy rate of 3% is when the tenants, the renters, and landlords, it's a sort of an equilibrium situation. 1.5% is an extremely low vacancy rate. Vacancy rate in Montreal is similar to Toronto, 1.5%. Vacancy rate in Vancouver is 1.1%. Now, Canada is an open immigration policy type of a country. Let's compare it with, go to the other extreme, compare it with Japan. Japan has a vacancy rate close to 14%, a closed immigration country. let's talk about vacancy rates in south of the border. In US, many states have double-digit vacancy rates. The average annual appreciation rate in US is close to 7%. The fact that the vacancy rate is 1.5% is because of a reason. And that reason is, first, the influx of immigrants. Second, unfortunately, um, the stress test, the rising prices, exponential increase in housing properties prices, and the fact that the other thing that's in play over here is the effect of stress test. I kind of lost my thought here. What the stress test has done is really unfortunate. It has resulted in people who are worthy of home ownership. If a family who's, let's say, the husband is earning or wife is earning $100,000 and the partner is earning $50,000, if family earning $150,000 is having challenges to qualify for a home, uh, and that's a reality. But what it means if you are a landlord, if you are an investor, it means that you have pool of very qualified professional tenants out there. You do not have people who are struggling. There is a considerable number of people out there who qualify for home ownership, but they're forced to stay as tenants. So those are some of the factors related to demand, and there could be more, but we again going to look at the time over here. Control. So I have a question for you. When you invest in any stocks or any shares, and like, what kind of control do you have there? You sit back and you analyze. You are not the ones making decisions over there, right? And I'll give you the example of a company, an automobile manufacturer, whose stock prices slashed in a matter of days because it was found out that some of their technical people were lying regarding the emission tests. And so what kind of control a person has in such situation? Very little control. In real estate, you have quite a lot of control. If things starts to go bad, you could change the use of the property. You could invest in it and have it appraised at a higher value. You could make it more appealing and more marketable by investment. So you do have control here. And the third thing I'm going to talk on the next slide is the exit strategies. So in case of real estate, you have a number of exit strategies. You could rent the property. You could sell the property. You could change its use. You could offer it for rent to own type of a proposition. You could increase its value. You could have it appraised at a higher value. You could pull out equity. So all this is available to you in case you want to adjust and you're finding your investments are not doing what they're supposed to do. So that's a big difference here. You have multiple exit strategies in this case. Okay, so there if you are not convinced as yet, and a lot of people are not. I had a call from my colleague from Rogers from like a decade back, and he calls me and he mentions that he's looking to buy an investment property, and the second sentence he tells me, and which a lot of people do: I don't want to be a landlord. I have heard people like horror stories, people break things, you get calls in the middle of the night saying that the toilet has broken down and tenants would damage my property. I listen to all this, but there are two things I want to say. First of all, when you are investing, you can set things in place at the beginning that you are safe in terms of such situations. One of that is, if you are, which I assume a lot of you are, busy professional, you could use the services of a property management company. In some cases, it's highly recommended because they have expertise in a lot of stuff which you don't have, and they could be. I mean, I manage my properties myself. That's because I have a professional team that I work with, and so it's easier. But I'm just saying this for an example. You could have a property management company. The amount that you give to the property management company is tax deductible. So it's not an unrealistic amount also that we are looking at over here. Plus, you could put in right type of insurance and that could protect you not only from the damage, but the rental loss due to damage. And these are just a couple of examples that can be done. And again, let me tell you one thing. A lot of you are working in organizations and in responsible positions, and I hear from people that their employers are calling them in the middle of the night, and they're responding, and they're 24 hours working. When you buy an investment, you need to take care of it. You cannot expect that you would not put in absolutely any amount of effort and it will go. Like everything else, it would need your attention, and that's a given over here. Okay, so I went through a lot of this stuff. In this slide, I just want to let you know, as an investor, as a realtor, as somebody who's been in the industry for a couple of decades, how I can play a role here if anybody wants to go to that route. And what I have learned, and for me, for this pandemic, I had to actually sit down and I did a lot of research and actually put some method into the madness and come up with a um, uh, more controllable way of measuring the return on investment on your property, and putting systems in place. There are quick calculations that you can do in minutes to assess whether a property is worth investing or not. There are some key economic questions that you need to answer for any area that you are investing in. You need access to a professional team. Typically, for a real estate purchase, you don't need a lot of people. In the initial stages, you need a realtor, you need a realtor and a good mortgage broker. However, along the way, you would need an accountant, you would need a bookkeeper, you would need a home inspector, you would need tradespeople, you may need a paralegal, you may need a property manager, you may need an insurance provider. So there are a number of individuals that are involved here. So being in the industry for such a long time, having used the services of some of these individuals for myself as well as for my clients, I have access to reliable resources that could be of use. Help regarding where to invest. Now, I want to let you know a little bit about, and when I talked about how is the current situation going on, and I talked about the fact that people are moving towards suburbs. What was typically the case was, just think of rings, inner rings and outer rings. If you look at the central core of the city, what was happening initially was high appreciation was associated with the inner rings of the city, or the central core. And the cash flow, because the prices have gone up so much in the central core of the city, the cash flow potential is a lot less. Think of buying a condo with access to a subway. It's really difficult to break even on an investment like this, let alone give you a positive cash flow. But the picture is changing. There are lots of outer rings where there is not as high, but there is appreciation as well as possibility of a cash flow. So I can help identify those outer rings and suburbs which have potential because of the developments that have taken place, and which are investment worthy. Now, help with screening tenants, analysis, and you may have bought your principal residences or properties, but there is a lot of analysis involved. And a lot of people just don't even see what that analysis is. And I'll give you the one big example, which is of a home price index. And being a realtor, we have access to home price index. What a home price index is, first of all, don't be fooled by average price of a home. When you analyze any area or any street, for example, there could be properties. Let me give you an example of a Bridal Path in Toronto. The highest, on the higher side, their property worth $80 million. A typical property there is $6 million. So if you do the statistics and try to find out the average price, the numbers would simply be lying. So what home price index does is that it's a sophisticated algorithm by regression analysis, in which a number of things are done. it removed the outliers, which mean the properties that are too high priced and properties that are too low priced. So it looks at the more at the benchmark or the median price, what a typical property is there. And that analysis is based on bunching properties with similar characteristics. Rather than comparing apples to oranges, you're comparing apples to apples. So that trend is available on 3 months, 6 months, 3 years, 5 years, 10 years, and back. So you have a lot of input in when you're making an investment decision if you have access to those. The last bullet over here is you saw the example of the spreadsheet that I showed you, and that's something new that I've started using for my investments. All you do is you plug in few numbers, the price of the property, interest rate, and it'll give you some really key statistics. And especially if you want to build a portfolio of investments, let's say even if the bank does give you your dormant equity to invest in one investment property, it would be looking at specific ratios for you to invest in another property. So such spreadsheet would be a big help in terms of finding out the real financial health of your investments. Okay, very quickly, I'm going to talk about the strategies in real estate. And I'm not going to go in detail, just I have listed them in order of the risk involved. The safest is buy and hold. You could buy, renovate, refinance, and repeat this process. You could invest in and think of an Airbnb type of a proposition. You could flip the property. You could buy pre-construction, and you can do construction. And the construction is the one with the highest risk because if you're not experienced in managing vendors, not aware of the cost, don't have that time, this could seriously backfire. I'm not saying that it's not possible, but could seriously backfire. You need to have some expertise, time, and other things, and access to really reliable vendor and relationship to get into that. So these are just in order of risk over here. Okay, I'm pretty much done talking. This is a case study of my first investment property, and why I put this case study over here is because I realize for some people it's a big leap of faith, and there's a lot of fear involved of when you invest in a property, right? And I can very much relate with it. When I invested in this property, that was my first investment. I decided to go full-time into real estate. I actually dipped in my RRSPs to invest in this property. And it was a leap of faith. At that time, I was not as educated. I didn't know as much as I know now. So if I make a decision now, it'll be based on more analysis. But I had just one factor in my mind. And the slide that I showed you with the why the suburbs are becoming more relevant, that's the only thing. My only rationale for investing in this property was, with the passage of time, the prices in the suburban areas are gonna catch up with the prices in the central core. So that was the key rationale. So I'm not just gonna sit back and enjoy the show now. This was a home that I bought. It was built in mid 60s. And I said the program project management type of a background, I just analyzed that, what kind of renovations I can do, how can I enhance this property, and I scoped out what are the deficiencies. Once I did that, I bought this home without an exterior, which again was quite difficult to digest at that time. But I sat down and I figured that out, that what would I need, and not that I had access to any resources. I started going into Home Depot and other stores asking for what kind of material would be available for this. I remember, with the help of my daughter, she built with crayon a exterior of the home, and I gave that to the contractor, that's the type of exterior I want. And believe it or not, he was impressed. He said most of the people don't even know to that extent that how they want their exterior to be. So that's just once I get going, that was the exterior. There were no window frames. There was no paint. There were old light fixtures. There were imperfections on the floor. Some of the doors were out of hinges. The This was the mud room, and as you see, it was in a mess. No window frames, exterior and interior. This is where I started transforming. The fireplace was left undone. So long story short, in a matter of 4 weeks, I was able to change the home. This was the new exterior. Um, this is the flooring in the mud room, the new light fixture, paint, doors inside and outside, window frames new, the laminate flooring in the laundry room. And this is the before and after. And I did all these things with very little investment knowledge. And let me tell you one thing about myself. I do have quite a lot of strengths. I am not a handy guy at all. If a light bulb fuses in my home, I would wait for 4 or 5 light bulbs to fuse, and then I would ask a handyman to come and replace those. So I had very little knowledge in terms of any repairs or anything like that. So, and that's this slide is basically, you could, as I said, in outer rings there are many areas that have potential. That's one area, which is the northernmost municipality of York region, Georgina. I feel that there is a lot of potential over here. I have invested in a few properties in this area for the reason that it's 1 hour distance from Toronto. It is because the highway was extended, 404 was extended to area called Keswick over here in 2014 or 15, and that's when the area started exploding. There are many other communities here. This has this area has waterfront properties too, so that's more of a cottagey type of a feel to that. And those areas are called Sutton and Jackson, and those areas have potential if you have interest in the waterfront properties. And that's just a general slide giving you example of one area that is there for investment among many others. Okay, this is the last slide. I think I'm almost done here. There's some mental modeling flaws when you invest in real estate. Some people believe that real estate is only for the wealthy. So let me tell you the journey that I took. I started 2 decades back with a basement the size of a truck. That's where I started from when I started my journey into real estate investments. And the fact that some of you have access to dormant equity, it's very feasible and doable to use that for investment properties. And I have access to experts who could help you and guide you in that with that respect. Some people believe that real estate is only for highly knowledgeable. So let me tell you one thing, and there may be some people who I see Nadeem sitting over here. There's some people who when you are investing in a stock or in a fund, you need a lot more specialization, and it's not easy managing that type of an investment. If you compare that with a real estate investment, there are some basics. You need a couple of good people to guide you in terms of that. If you have access to few of those tools, it is very viable, and it's not rocket science. It's a lot of people are millionaires by default just because they owned the property 10, 15, 20 years back. So there's no rocket science to it. I feel that the knowledge barrier is not as great as many other types of investments. A fear of an impending price collapse. Okay, so let's be realistic here. Any investment that has performed so consistently and overperformed so consistently is bound to collapse. So when there is if I say market correction is not going to happen, I would be a fool. Market corrections is a reality. And when I plotted the last 4 decades, there are 2 major significant market corrections, and the annual appreciation includes those 2 market corrections. So there is a possibility of a market correction like any other investment. However, if you have done your homework and you have invested for a time span of 5 to 10 years or a little bit more, then, and you could ride those downturns, you are really, really good with this type of an investment. The last one is analysis paralysis. A lot of us have this disease of overthinking and too much analysis. And for many very, very capable individuals, this stops them from making decisions or taking a step here. So there's some people who would like to know everything about something, but they don't want to take a step and take some risk and start with it. And like I gave you the example of my first investment property, a $300,000 home. What do you get for $300,000? Almost nothing, right? So in my mind, I was thinking, how bad things could turn out to be, right? So and I was seriously rewarded for that jump. The future properties I bought were more calculation involved, but interestingly, this one was a star among those. That basically the last modeling flaw is paying off debt. Even some people are obsessed with paying off their good debt, and that's very unfortunate. A lot of people borrow from their dormant equity for pure liabilities considered, and buying boats, buying luxurious cars with your dormant equity. And that's what I call risk. Risk is not spending on assets that generate uh, good cash flow, that generate good price appreciation. So this is the last point that I want to say. Now I like to open it up. If you have any questions, I'll be more than happy to address those. If you had any questions, then you put it in the chat box. My assistant Cookie is there. She's gonna let me know, and I can get back to you. You have access to my email and my contact information. Feel free to reach out to me if you have any individual questions, or if you want to look at some specific situations. I'll be more than happy to assist there. So again, I highly appreciate your time. Feel free to ask any question, and I'll be there for you.
Ali, this is Nadeem. First of all, a great presentation. You were a great speaker. It was kind of a music to my ears for an hour or so that you spent. You're very knowledgeable. Thank you very much for that. My question to you, how do you compare REITs, the real estate investment trust, guaranteed 10%, sitting in a TFSA with the investment property where you have to pay 50% capital gains to the government? How do you compare that?
Okay, so the capital gain is a reality, right? And first of all, we need to define for others what capital gain is, right? Once you invest in a property and you sell that property, and if it's an investment property, if you have $100,000 profit on that property, 50% of it would be subjected to capital gain, right? That capital gain would depend on your tax rate at that time. In Canada, at $45,000, your tax rate is 33%, I believe, right? If you're earning $45,000. So I'm not denying the fact that there is a capital gain factor. But Nadeem, if you have a investment mindset and you are looking at building a portfolio, in my slide, because I kept the scope so higher, you don't kill a hen that lays golden egg. You don't actually sell your investment properties, right? If you have a portfolio of investment properties, you could sell one-off situation or buy a new investment property. However, you could have such income generation from multiple properties that you would still be extremely better off. And as I said, if you invest now, and in a matter of 10 to 15 years, which is the minimum time horizon, right? At that time, your the tax rate would be very different too. And again, there are some areas that I have expertise in. I have not myself invested in a REIT. Unfortunately, I don't know anyone who has invested in a REIT. When I put that example of investing in a property or a business or a share, that's typically where I see people invest, right? So I cannot speak beyond that. And if somebody has expertise to invest, because REIT is technically investing in real estate, it's just that you're buying mutual funds or stocks related to correct me if I'm wrong. It could generate amazing results. I'm not saying that. So that's my take on this.
Okay, thank you. I appreciate it.
Okay. If there is no other question, as I mentioned earlier, please feel free to reach out to me. You will get a thank you email and reply with any questions, any concerns. I highly appreciate your time on this Friday evening, and I look forward to do more webinars, maybe invite some experts in some other areas that you find useful. Give your feedback if you want to see a property manager, if you want to see an accountant or taxation aspects of investing. I'll be happy to arrange those webinars. Thank you very much, and stay safe.